Chapter 10, Stockholders' Equity. The last section of this chapter discusses how to evaluate company performance using information found in the stockholders' equity section of the balance sheet. The first measure that we look at is the return on equity, the ROE. It measures the ability of a company's management to generate earnings from the resources owners provide. We calculate the ROE by taking net income divided by average stockholders' equity. Remember, when we're trying to find the average of something like stockholders' equity, we take the beginning balance in stockholders' equity, the ending balance in stockholders' equity, add them together, and divide by 2. The dividend yield is the next measure we're going to look at. Investors are also interested in knowing how much a company pays out in dividends in relation to its share price. The dividend yield is computed as dividends per share divided by the stock price. So here's some information for Facebook and IBM. Everything is in millions except for the share information at the bottom. You see the net sales, net income, total liabilities, stockholders' equity beginning, and stockholders' equity ending for the two companies. You also see the stock price listed per company and the amount of dividends that have been paid, as well as average shares outstanding. So just looking at this information, we see that IBM has much larger net sales. However, Facebook and IBM are very comparable in their net incomes. Facebook has very low liabilities compared to IBM and very high stock equity compared to IBM. The stock prices you'll see listed below. Also notice, Facebook does not pay dividends, whereas IBM is paying $5.50 per share. And Facebook has almost 3 times as many shares outstanding as IBM. So just a little bit of looking at the information before we get started on some calculations. So first, the return on equity for the two companies. Remember, return on equity is net income divided by average stockholders' equity. So if you take a look at the two companies, remember their net incomes were somewhat similar, but their average stockholders' equity is very different. So for Facebook, we get a return on equity of 19.8%. whereas IBM has 72.4%. At first, you might think this means Facebook is less profitable in terms of return on equity. That is true. However, a big reason for the difference in return on equity is that Facebook relies to a greater percent on equity financing, whereas IBM relies on debt financing. If you take a look back, you see the amount of debt IBM has compared to Facebook. So Facebook is raising their funds through the sale of shares and equity into the company, whereas IBM is raising funding a lot through debt. The dividend yield for Facebook and IBM. Well, the dividend yield for Facebook is obviously 0. They haven't paid any dividends per share, so 0 divided by the stock price, there is no yield. IBM, however, is paying a dividend per share of $5.50. Stock price is $165.99, so their dividend yield is 3.3%. Next, we'll look at earnings per share. Earnings per share, or EPS, measures the net income per share of common stock. We calculate earnings per share as net income minus preferred stock dividends divided by the average shares outstanding during the period. The upper half of this fraction measures the income available to common stockholders. We subtract any dividends on preferred stock from net income to arrive at the income available to the true owners of the company. If a company does not issue any preferred stock, the top half of the fraction is simply net income. Earnings per share is useful in comparing earnings performance for the same company over time. We do not use earnings per share in comparing one company with another. because of the wide differences in the number of shares outstanding among companies. The fourth calculation you need to learn is the price earnings ratio, the PE. It indicates how the stock is trading relative to current earnings. We calculate the PE ratio as the stock price divided by earnings per share, so that both the stock price and earnings are expressed on a per share basis. Price earnings ratios commonly in the range of 15 to 20. A high PE ratio indicates that the market has high hopes for a company's stock and has bid up the price. Growth stocks are stocks whose future earnings investors expect to be higher. Their stock prices are high in relation to current earnings because they expect future earnings to be higher. On the other hand, value stocks are stocks that are priced low in relation to current earnings. That low price in relation to earnings may be justified due to poor future prospects, or it might just suggest an underpriced stock that could boom in the future. So looking at Facebook and IBM, we see their stock prices listed, and then we calculate their earnings per share as their net income, and they don't have any preferred dividends, so the top part of the fraction is net income divided by shares outstanding, and everything here is in millions. So Facebook stock price divided by the earnings per share is 32.2. IBM one stock price divided by earnings per share is 13.4. So we see that IBM has a somewhat lower PE ratio because it's more of a stable company, whereas Facebook's PE ratio is almost double what the common range is because it is a growth stock. Investors anticipate future earnings of Facebook to be higher than they currently are now. That is the end of chapter 10.